Hello and welcome. Today we're exploring premium financing, a strategy used in certain life insurance arrangements for qualifying high net worth individuals. In estate and financial planning, it's important to look at the full picture, not just any single tool, but how different strategies work together toward your long term objectives. Premium financing is one such tool that, when properly structured, can play a role in that picture. Here's how it works. A borrower works with an independent, third party lender to fund premiums on a large life insurance policy, typically an Index Universal Life or IUL, or a whole life policy. The loan is secured by the policy and, in many cases, additional collateral. This approach is designed for high net worth individuals who may want to put a significant life insurance policy in place while managing liquidity for other purposes. It is a complex strategy with real risks, which we'll address directly. The foundation of any premium finance arrangement is clarity around your objectives. Are you focused on preserving wealth, creating a death benefit for your heirs outside the taxable estate, or structuring a charitable legacy? Perhaps your priority is business continuity or tax efficient wealth transfer. Whatever your objectives, the strategy must be built around them, not the other way around. That clarity influences everything: the type of policy selected, the financing terms, and how this fits within your broader estate and financial planning strategy. An IUL policy may be appropriate for clients seeking cash value growth potential linked to a market index, subject to a contractual floor that limits exposure to negative index returns. It's important to understand that in a premium finance context, loan interest accrues independently of index performance. If the policy's actual performance falls short of illustrated assumptions, additional collateral or out of pocket contributions may be required. Whole life insurance offers a contractually guaranteed death benefit and a minimum guaranteed interest rate on the guaranteed elements of the policy, which can provide a measure of stability. Neither policy type eliminates the risks inherent in a leveraged arrangement. To illustrate how this might work in practice, and these are hypothetical examples only, individual results will vary and are not guaranteed. Consider a client focused on estate planning who wants to preserve liquidity for business opportunities. Using premium financing to fund a whole life policy, he may be able to put a substantial death benefit in place for his heirs without committing personal or business capital to annual premiums. The loan funds the premiums. The policy serves as part of the collateral. This requires careful underwriting, lender approval, and ongoing management, and is not appropriate for every client. In another hypothetical scenario, consider a high net worth individual with a sizable investment portfolio seeking strategic diversification and an estate planning vehicle. A premium financed IUL could provide a death benefit alongside potential tax advantaged access to cash value, though tax treatment depends entirely on policy structure and individual circumstances, and a tax advisor must be involved before any decisions are made. Now let's talk about risk directly, because this strategy requires it. Premium financing carries several risks every client must understand before proceeding. First, interest rate risk. Most arrangements use floating rates, and if rates rise significantly, the annual cost of the loan may exceed what was originally illustrated. Second, policy performance risk. Illustrated values are non-guaranteed projections based on current assumptions. If actual performance is lower, the strategy may require additional collateral or contributions to remain in force. Third, lapse risk. If the policy lapses while a loan is outstanding, the forgiven loan balance may be treated as taxable income, a significant consequence that catches many clients off guard. Fourth, lender risk. Financing terms, collateral requirements, and loan renewal conditions can change over time. There is no guarantee that financing will remain available on the same terms throughout the life of the arrangement. This strategy is not suitable for all clients. It requires close collaboration between your insurance professional, independent lender, tax advisor, and legal counsel. A critical component of success with premium financing is ongoing monitoring. Interest rates change, policy performance fluctuates, and personal circumstances evolve. Regular reviews with your professional team help ensure the loan structure, collateral position, and overall strategy remain aligned with your goals. Adjustments, including restructuring the loan or modifying funding levels, may be necessary over time. When all of those pieces come together correctly, premium financing can be a meaningful tool within a broader estate planning or wealth protection strategy for the right client. I encourage you to explore whether it fits your situation with your insurance professional, your tax advisor, and your legal counsel involved from the start.